Gary, thing number three, we're talking S&P 500 earnings. Lots missing the mark. Thing number three, analysts missed the mark on 22, 23, and 24 now S&P 500 earnings, Gary.
Well, Rob, for years it has been a point of pride and sport around deep knowledge investing to poke at the sell side, which is really more advertising and less research. Um, Back in late 2021, we put out a white paper for people warning that inflation was not transitory and was going to be huge and a gigantic problem. And we told people what to do. In 2021, we told people to buy energy, gold, Bitcoin. Hey, that worked out really well. Um, and at the beginning of 22, we said to people, the Fed is going to hike rates. That's going to take the market down and it's going to reduce company earnings. The company earnings estimates are 100% wrong. Now, at the time, I'm checking the chart here, the estimate for 2022 for S&P 500 earnings was around $230. That ended up going down below $220. We were right about that. The 2023 estimate at the time was over $250. And that came down. At the time we were talking about it, the estimate fell to 230. But if I check a later dated chart, the final 23 number came in right around 220. So I think we had 2022 starting around 230, and it came down to about 218. That's a big drop. The 23 number started around 251, 252, and that ended up around 220. So why am I pointing all this out? Well, the reason is if we look at the 2024 estimates, those started around 275 and are now down to just above 240. By the way, I want to thank Dr. Ed Yardini from Yardini Research, who generously allowed us to use one of his graphs showing this. If you look at the written version of the five things, you'll see the Yardini graph. It is excellent work. So Dr. Ed, thank you so much. Really appreciate you. That is Yardini Research for anyone who wants to take a look. But the 2024 estimate has come down from about 275 to right now it's just above 240. Now, why does that matter, Rob? It matters because the 24 estimate is now below where the 23 estimate was 2 years ago, and the market has done nothing but go straight up. So we have a situation where the analysts keep saying earnings are going to be great, and then they're wrong, and the earnings keep coming down, and we are now at a point where the earnings are more than a year behind where they were a couple of years ago, and the market has gone straight up. And if that doesn't concern you, I don't know what would.
And Gary, on that point, I mean, what did you see? What did DKI see that others didn't? And what have you guys done to obviously position your portfolio for a situation like this?
So we saw a couple of things, Rob. One is generally higher interest rates will slow the economy. We correctly did call a recession in 2022. A lot of people say we didn't have a recession. That's nonsense. We had 2 quarters of negative GDP growth. The truth is, our private market, our productive private market economy right now is in a recession. The only reason we are not officially in a recession right now is because our government is overspending by trillions of dollars. That adds to GDP, whether it adds value or not. So, what we've done is loaded up with, again, things that do very well in an inflationary environment. We own a lot of gold. We own enormous amounts of Bitcoin. We've owned a lot of energy. And then I found high growth stocks to invest in, and we've hedged out the market exposure. Now, there have been times that hedge has been profitable, and other times it hasn't done so well. But as long as our individual stock picks outperform the market, which they have, it's turned into a much lower risk but very profitable trade for us. So these are the kinds of things that we've been able to do to help deep knowledge investing subscribers navigate through a really difficult and confusing market.
Great stuff there, Gary.